So let me introduce your presenters today. I think you know all of us, but if you don't, there's our mugshots. Philip didn't want to have his photo taken. Now, Tom Williams, Tom, you were 40 years old there, I think? Something?
Yes.
Yeah, you haven't changed a day. You look exactly...
I was about 50 there.
Oh, about 50, all right, okay. So there's the master in the middle, Tom. Most of you know Tom, you've read his books. The Undeclared Secrets That Drive the Stock Market or Master the Markets. And Tom, as you know, is a retired syndicate trader who traded in Beverly Hills, California many years ago. He retired at 40, multimillionaire, returned to the United Kingdom and decided that he wanted to help others to understand the mechanics of the market. On the left there is Philip Friston. He's a professional fund manager here in the United Kingdom. He's been trading with VSA for over 20 years and is considered an absolute expert in his field, and is giving up his time today and I thank him for that, to share with us his experiences and his knowledge of the charts, which I think you'll find quite exceptional. And then there's my mugshot there taken in Chicago, where I live. I'm a professional trader. I am a VSA expert and I'm the CEO of the company, as many of you know. Let's have a look now at what the objectives for today's session is and next week's. Number one, we want to learn all the VSA principles and then put them into context to include background and trade setups. To learn how to identify the highest probability low risk entries using volume spread analysis. To learn how to clearly identify professional distribution and accumulation and know where and when to take a trade. To learn how to identify market tops and bottoms. To understand the herd and weak holders, most importantly, and how to avoid becoming either of these. To learn what is a shakeout and how to recognise and profit from the manoeuvre by professionals. And for those of you in the United Kingdom who think I've spelt that incorrectly, I haven't. Philip Friston thought I had, but that is how we spell it in the States. Understanding the upthrust and where to place a trade after you see this. To learn the significance of the range or spread on any individual bar and how to put it into context with the background. That is vital. You're going to learn a lot from Philip today about how important reading the background of the chart is to being able to identify a trade setup. And this is something that we've never gone into so much depth on, and you'll find today that it will become very clear to you. Understanding, as I've just said, why the background is vital to placing a trade at the right edge. To learn why multiple time frames are important and how to choose the right time frame for your chosen market. And here's the final one on this section, understanding what is a test and the different types of tests that can be both bullish and bearish. To learn how to identify VSA patterns as they appear and be patient to get the best entry. All VSA patterns seen in hindsight must have been there as they unfolded in foresight. Now, isn't that an interesting comment? Tom always says to me that, it's very easy to look at a chart and say, well, look, there's a no demand after end of a rising market or whatever the setup is. But if it was there on a chart in hindsight, it had to be there at the right edge. But do you have the confidence to A, identify it, and B, pull the trigger? And this session will really help you be able to do that. To get your questions answered about specific issues you are having with your trading and investing, and to gain confidence in your chart reading ability. This is a chart reading masterclass. We want you to understand supply and demand and the effect that has on the imbalance that has on a chart. So when you get an imbalance of supply and demand, we are then looking to see how the professional side of the market react to that imbalance. To know the best place to put a stop loss, a market order or a buy-sell order above or below price action. And also, one of the other reasons we're here is to learn from other like-minded traders. Next week, we're going to be asking you to send all your charts in to us. And, when you send your charts in, we're going to know from all of you how you're grasping these concepts. So we're going to start by looking at the major VSA patterns, and we're going to go into a lot more depth than we've done in the previous boot camps, or in fact in any other event that we've done. So let's look at what is a sign of weakness. Okay, now there are several principles we're going to cover, but they're all based on volume. As you know, volume is the key. But volume in its own right only tells you part of the story, which is why we always need to look at the range or the spread of the bar. Now let me be very clear what that is before we start here. The range on any bar is the high and the low of the price action on the bar. So if Microsoft started the day at $1 and moved up to $10, it would create the height of the bar. We call it the range in America, or the spread here in the United Kingdom and Europe. But that spread is very, very important. But when we look at the volume underneath that, it's the activity of the professional money. The spread tells us what the price did, but the most important part is the closing price in that spread. Okay, it's very, very important. And once we see that, and we see that range or spread with the closing price, we look at it relative to the previous bar, and then we look at it relative to the background. And that then gives us a clear indication of what professional money is doing. Now the volume can be high or low. Ultra high volume is very important, as you'll see, but so is very low volume. Ultra high volume means the professionals, the smart money, and the herd are all active. Low volume tells us the professional money is inactive or withdrawing its interest. And that's important too, because professionals drive the price. The narrow spread will often indicate supply, especially at the top of the market, where you see a high volume up bar, as we're going to show you in the end of a rising market. The supply caps any attempt to move up. Ultra high volume up bars is a classic trap by smart money to encourage traders to go long, especially at breakout levels. And we'll show you today how to avoid being caught by false breakouts, which do trap people or lock them into a bad trade. Professionals have no interest in the upside. You see low volume. If professionals are selling as the public are buying, usually on good news, you'll get high volume or even ultra high volume. High plus volume shows supply, especially on an up bar. That's important. Wherever we see high volume, there's supply present, and it will always be either tested if it's bullish, or if it fails, you're going to see no demand, as we'll show you. Public buying, smart money selling. The smart money have to sell into public buying, which is why in the stock market they specially use news to drive the herd to do what they want. It's almost like the sheepdog and the herd of sheep, isn't it, Philip?
Just, yes.
And I know you're a fund manager and you're obviously searching around for high probability trades to take. What's your main criteria really when you're looking for a stock to buy? What would you be looking for?
Well, the first thing I'd be looking for is a stock that's actually there's been in a downtrend where you see very high volume coming in, not just on one bar but possibly on several bars, showing that there's accumulation beginning to take place. Mm-hmm. Then I would be looking for that to continue, and later on to get some testing. If you then start seeing it going up, and it begins to outperform the index, and you get testing a rising market, you've then got an ideal setup.
My favourite one, which we're going to show them, aren't we?
Yes.
So we're going to do that as well. So when we see low volume on an up bar, okay, so remember we're looking at signs of weakness at the moment. This shows no interest from smart money, so prices cannot go any higher. So Philip, what I'd like you to do here, could you define for us weakness or supply hitting the market? Just your definition of weakness on a chart.
Well, weakness really is professional selling, which would normally come in after you've had a period of rising prices, and then you get the professionals deciding that prices have they've made sufficient profit at that point and they want to perhaps move on to something else, so they'll start distributing, usually on good news, because it's the best way of distributing, because if the news is good, the public will be buying, the herd will be buying, and that gives the professionals an ideal opportunity to distribute that stock without moving the price down against them.
Can I ask you a question then? A question came in from the survey. What is the difference between distribution and out and out selling? Because, you know, some people think distribution is selling. Well, that sounds fairly obvious. But actually, when we thought about it, there's more to it. Distributing something, when you distribute some sweets, say, out of a bag, you know, you can either tip them all on the table for the kids, or you can give the kids a sweet at a time. So how would you describe distribution versus selling?
If you see end of rising market signal, which is your narrow spread up bar on ultra high volume,
Mm-hmm.
that is selling, but it's also distribution, because, as you say, the sweets are all being emptied out of the bag at the same time, if you like. That's a very good analogy.
And our next chart that we're about to show you, ladies and gentlemen, which some of you have seen, absolutely shows this in action. Carry on.
But the other way of doing it is that you get an up bar with perhaps quite a wide spread, with ultra high volume, and then, as Tom would say, it gradually mushrooms over as further distribution is done over a period of time. And that's emptying perhaps one sweet out of the bag every so often.
Why do they do that, though? Why not just sell, if you've made money at once, why not just sell everything at once?
Well, it would depend how easy it is to distribute. Not every stock can be distributed, or market can be distributed in the same way. If a stock is very liquid and there's plenty of public who want to buy, then it's fairly easy to distribute. But that may not be the case. It may be quite a thin market, and it might be quite difficult for them to distribute their stock, so they have to try and do it over a period of time.
Right. So they do this on bad news or good news? Because clearly, I mean, you're talking about public buying something.
They have to do that on good news.
Right. Now, so good news in a stock would be something like earnings reports, or...
Yes, it gets marked up on the earnings report, and the professionals use that in order to distribute stock. But they have to be careful if they distribute. They don't distribute too quickly and start moving the price down too heavily against them until they finish that period of distribution.
And then you often see this widespread down bar that just locks everybody in. Now, you were on the other side. You were the smart money. You were the professional money. You retired. You chose to bring this to the public's attention. It has got their attention by the fact that we're completely sold out on this event and oversubscribed. And indeed, your books now are selling all over the world in 40 countries. And when people read the book for the first time, it looks like it's contradicting itself, because it says, right, well, ultra high volume on an up bar is a sign of weakness. You know, it's weak. And then in the next chapter it says, now no demand, which is a low volume up bar, is weak. How can both things be the same?
Yeah, that's very interesting. That's why, in a way, you're wasting your time talking to uninformed people or people not interested in studying the market, which they should do, because they hear you talking about ultra high volume and up bars is bad, and then you suddenly say, oh, low volume as well is. So that really messes them up. But the reason is, of course, they don't understand that the volume that's represented at the bottom of your chart is actually a recorded recording of the amount of activity that's taking place on that particular bar by the professional money. And that's what they don't understand. So if the market shoots up, it'd be marked up by the market makers and specialists in the cash market. They mark it up, deliberately mark it up, which is done very frequently, but the professional money, if they're bearish, they look at it and say, well, carry on, we're not interested. And they sit back and let them carry on with this. It'd be only temporary, and therefore the volume will be low. And that's what we call no demand. Very, very important. And some of the best opportunities to short those markets is when you see no demand like that.